Hi, I've made several videos lately on the Federal Reserve bringing us in for a soft landing by putting up with a little bit of inflation, and this is not one of those videos. Instead, this video will attempt to answer the question, when will the excrement impact the air acceleration device? I think that 2023 is not going to be a great year for the economy in general. But first, I'm going to take a little detour and we're going to see what kind of job the Federal Reserve has been doing when it comes to their stewardship of the dollar. And recently, I did an internet search on the attributes of money. What are the attributes of money? And what came up right away as one of the top listings first, money is a store of value. If I work today and earn $25, I can hold on to the money before I spend it because it will hold its value until tomorrow, next week, or even next year. Remember that one, next year. In fact, holding money is a more effective way of storing value than holding other items of value such as corn, which might rot. Although it is an effective store of value, money is not a perfect store of value. Inflation slowly erodes the purchasing power of money over time. Now, there are definitely some contradictory statements in here. To get rid of all this stuff in the middle, all of this noise that they've introduced, if you take a look at these two statements. First, money is a store of value. And then the last statement, inflation slowly erodes the purchasing power of money over time. If you know the difference between currency, fiat currency, and money, the first statement is a true statement of money. The second one is a statement that only applies to fiat currency. If you take a gold coin that was minted 1,000 or 2,000 years ago and you melt it, that gold can then be used in trade. You can buy about the same amount of stuff today, relatively. It bounces up and down in a valuation range. Today, it is at a low in valuation. It should buy many, many times more stuff than it does right now. But, it purchased something 500, 1,000, 2,000 years ago. It still purchases something today, and it is that purchasing power is going to rise. We are in, I very often say that there are these brief moments in history where gold and silver, the safe haven financial asset, have the greatest potential gains in purchasing power. And we've been in one of these periods since the year 2000, roughly, so this century. And what happens with these moves is 80% of the move comes in the last 20% of the time. And I believe that the next couple of years here, the next 3 years or so, is going to be that 20% of the time. But, remember that they said that you can make $25 and next year it'll still it'll store that value. Well, if you purchase something, if you made $25 last year and you spend it this year, it only purchases you $23 worth of last year's stuff. $2 worth of your work and time and effort has been stolen from you. It was stolen from you by the Federal Reserve expanding the currency supply, diluting the currency supply, stealing your purchasing power through inflation, and then transferring that to whoever received their newly typed fiat currency first, which is in the financial markets. So it was a transfer of wealth from you to Wall Street. And so here is what the Federal Reserve has done in their stewardship of the dollar since their existence. Oh, by the way, who said this? The Federal Reserve. And there is the URL at the bottom, and it is the 9 functions of money. This is the first one. It's got to be a store of value. Money is, fiat currency isn't. So here is their stewardship of money. And as you can see, it starts out at about 1,050 here, I believe. I looked at the chart very closely when I was making this chart. And it drops to 30. And so the Federal Reserve, 97% of the purchasing power has been lost. In other words, in 1913, the 3 cents it takes $1 today to buy what 3 cents would buy you back in 1913. So if you think of the amount of candy that cost 3 pennies back then, it now takes a whole dollar to buy that same amount. You know, there used to be a half penny. Why? Because the penny was way too valuable. Is there anything that you can buy with a penny today? And the answer is no, there isn't anything. So now we're going to get on to when will this happen? This is what most people look at when it comes to predicting recessions. The 10-year Treasury yield minus the 2-year Treasury yield. When it goes negative below that zero line, it means that there's going to be a recession sometime in the future. And you can see here that there was like a more than a year lag, almost 2 years lag between the time it went negative and then reverted back to positive. Here, it was just a couple months, but it reverted back to positive before the recession happened. Here, it was a little over a year, reverted back to positive. But look at where we've gone now. This is the most negative in the history of the data that the Federal Reserve has. So we could be in for a real doozy, and I believe we are. Now, I like to follow a bunch of different indicators. This is the 10-year minus the 3-month Treasury. This, instead of being about 2 years, is about a year and a half. Here we have like a month or so. Here we've got 3 or 4 months, maybe 5 months. Here it went positive and then went negative again just as the COVID crash recession happened. But here we're about as negative as the recession of 2001, 2002 from 9/11 and the NASDAQ crash. Here we've got the 10-year minus the Fed funds rate. So this is 10-year bonds, and this is the Fed funds rate, which is instantaneous. So all of these are people, long-term bond investors that are loaning their currency to the government for 10 years versus short-term cash, short-term investors that are looking to invest. This is the Fed funds rate, so this is the most instantaneous rate. The 3-month Treasury and the 2-year Treasury are shorter term, and so when bond investors that are going to loan their currency to the government for 10 years are less worried than somebody that's going to loan their currency to the government for 3 months or 2 years, when those people are more worried about the, are they getting rewarded for the risk that they are taking? When they are more worried, it's a sign that there's trouble in the economy. You should be charging more to loan your currency. For the longer the term is, the more you should be charging, period. So what you see is that this went negative just in the past few weeks here. So it's another indicator that has flipped and is saying, now this one went negative just recently. It's the 5-year minus the Fed funds rate. And what you see here with these last two charts, there's a lot of false positives here, but they are already negative when the recession begins, with the exception of this month or so right there. They're all already negative. Well, this has gone negative. So, and here we have, I want to thank George Gammon for this. Thank you, George. Fitted instantaneous forward rate 2 years hence minus the 2-year constant. So these are both 2-year things, but I don't know what the fitted instantaneous forward rate 2 years hence is. But and it's a pretty funny name, and George pointed that out also. But you can see that it tends to be a little bit closer. It's too bad this data doesn't go back further to the onset of the recession. But you can see this one is also the most negative that it has ever been. And so we have something coming up, something soon. It's going to be in the first quarter, second quarter, most likely, of 2023, and it will be the triggering event that causes everything that I talked about in the past 2 videos to start coming true. So make sure that you have protected yourself. Do the best you can. And I want to thank you very much for watching. We'll see you next time.